Hello, everyone. Welcome back to the Kiss My Assets podcast. I'm your host, Kyle Macdonald, here with the CEO of Neighborhood Ventures, Jameson Manwaring. How are you doing today?
Hey, good morning. We're doing well. How are you?
Fantastic. Another sunny day in Phoenix.
Yeah, it's all good here, getting into the winter months, and good stuff is happening on the commercial real estate front as well.
Absolutely. So here on the Kiss My Assets podcast, if you're a new listener, we take a deep dive into some of the macroeconomics of the real estate market, as well as microeconomics, especially here in Arizona. But today we're going to talk about a couple exciting things happening, especially with this new administration who came into office last year. There was a new policy that came about of renewing 1031 exchanges and the rewarding the restoration of the full 100% bonus depreciation here in 2025. This regime and this presidency has really breathed new life into the 1031 exchange strategy, which is a tax deferral strategy of capital gains for real estate investors when they sell their properties. They can now use a 1031 exchange to defer those taxes, purchase a replacement asset, and immediately take substantial bonus depreciation on the qualifying components of their asset. Why is this a big deal starting off, Jameson?
Yeah, it brings back more of a strategic way to when you're selling an asset, when you have an asset and you're looking for some tax deferrals, depending on if you have high taxes that are due. This bonus depreciation gives you the ability to say, hey, let me sell my building on a 1031 exchange. Let me, I won't pay any taxes on that sell. I can go buy a new asset and immediately depreciate the heck out of it.
Yep.
And get a big write-off in that first year, a big tax deferral in that first year.
Yeah, absolutely. And as we all know, one of these 1031 exchanges also allow for a lot of freeing up of capital, right? That's one of the things that we've been discussing a lot is the lack of liquidity in today's markets, from refinancing to cash flow. But this is a great technique to free up capital for reinvestment or to bolster cash flow of these assets. And so, for you and, what you're seeing in the macro market, what does this do to deal momentum? What does this do for liquidity momentum in today's market? And when you talk about those two things, what does that mean for the sophisticated investor who's maybe sitting on the sidelines in today's market?
Well, one of the big challenges we've had since the Fed started taking interest rates up is that the deals and the transactions have gone off a cliff. There's been anywhere from 10 to 15% of the transactions that we have in a normal year for a good period of time now, 2.5 years. So this is something that could really impact that, and it's new. It's still in the early stages of seeing how this will impact deals and transaction activity, but it's expected, and based on the early kind of conversations and some of the things that we're seeing, and some of the early indications, is that it is kind of changed how people do some of their underwriting on deals, especially if you're a short-term investor, kind of a more of a quick deal in, quick deal out, which is a portion of the transaction volume, because these short-term incentives give people the ability to have these tax benefits, but they have to do a deal to have them. You have to do a sell, and then go buy another property. So on a 1031 exchange, you don't have to pay your gains on the exchange, but you have to exchange into a new like asset in a short period of time, and then you can do the bonus depreciation on that new asset. So these are the types of things that you look for as to what are the things that are going to change the trajectory of things. And we're in a low transaction environment. Things are pretty stale, not a lot of liquidity. You start to see a few of these things come together like this, and you can see how things will start to reaccelerate again. And this is definitely one of them. The one thing to keep in mind, and this is not something that you're going to see, in a YouTube clip or a 30-second discussion on this is, and I see these videos out there saying, buy an Airbnb and you can offset $1 million of your income in 1 year, stuff like that. And that's it's kind of like the piece of the iceberg that you see under the full ocean, and it's a much larger story because you also have to think about, what am I going to do when I sell this? If when you go to sell the property, that depreciation gets clawed back. There are some ways around that. You can potentially do a 1031 exchange on the back side of that, but bonus depreciation, depending on several factors, and it's you have to really do some tax planning. And we're not. I don't claim to be a tax planning professional. You really need to talk to your accountant, see where you're at, see what type of income is coming in to get offset as the first side. Because there's different buckets of income. There's earned income, and then there's capital gains income from investments. And those buckets have to stay separate on your tax returns. So you have to dig into it. You have to look at it. And then you have to have a plan on the sell.
Yeah.
If you don't have a plan on the sell, you might get this big tax advantage when you do the transaction on the front end in that first year. But then when you go sell it, that gets clawed back anyway. So you got to make sure that you have your ducks in a row and a plan put together. The other side of it is you have to have a great property. So you got to figure out, I'm going to do this tax strategy, and this is a great tax strategy, but what am I actually investing in? And you want to make sure that your investment is a great investment. It shouldn't just be about the tax strategy, and if it is just about the tax strategy, that's not going to be something you're going to be happy with long term. If you can find a great investment and it helps you from a tax standpoint, then now you're really talking. But we talk to a lot of investors who are looking for these type of tax strategies, had a lot of conversations about this. And at the end of the day, it's a priority that the investment they're investing in is a great investment and it makes sense from a tax standpoint.
Yeah. This article we were diving into, there's a couple quotes here I wanted to play on after what you said. It says the interplay between bonus depreciation, cost segregation, and 1031 like-kind exchanges now sits at the heart of commercial real estate strategy, making timing, execution, compliance more vital than ever. In this new era, 1031 exchanges may be more valuable, yet also more dangerous for those who misjudge their long-term plans or underestimate the cost of recapture at exit.
There's always more to the story, right? So that's the side that is important, and you need to work with a tax advisor who understands your situation. Not all accountants get this. Most accountants do not get this. So you need to talk to someone who really knows. We can connect you with some of those folks who can really walk through your situation. And just flipping it one more last time as we kind of close this conversation out, this is a great opportunity, a great incentive if you do it the right way. We talk about some of the things you need to make sure you're doing, some of the gotchas, that you want to be sure that you are have a good plan on the sell. But yeah, I think if you do it right, one of the great benefits of real estate investing are the tax advantages. It's one or two. The first one is probably the stability of real estate from a value standpoint, the fact that you can put leverage on it so easily. But one of the top benefits are the tax advantages, and that's what we're talking about here.
Yeah, absolutely. I actually have a scenario happening right now in a deal I'm invested in where the way it's set up, it's an LLC operating business, and each investor in the deal is an active business partner. And we have a person who's going to 1031
Yeah.
their interest into our LLC, our business that controls a project in South Carolina. And it's really interesting because, you know, in these 1031 scenarios, a lot of the common story you hear is someone going from one asset to another. There's also a lot of creative strategies like you're mentioning, you know, and talk to a tax professional, but you can get into, you know, secondary positions or primary positions in other real estate interests and be a partner with other people on these deals. And so I've just seen that really as of the last 2 days. Really interesting example.
And in some structures will allow that, and some will not.
Yeah.
So the most common structure is a TIC structure. 10 in common will allow funds coming from a 1031 exchange. Our structures and neighborhood ventures do not allow 1031 exchange money because they aren't this tenant in common structure.
That's right.
And there's other, you know, we won't go down that rabbit hole, but there's positives to the TIC tenant in common structure, and then there's some negatives too. So you want to make sure that you understand that. And I also think for this strategy, if you're doing a 1031 exchange and doing bonus depreciation, it gets really complicated if you have multiple partners doing that. And you have to align your partners all with the strategy, and they have to be aligned, and they have to want the same things you do. It gets very difficult. This works best when there's it's either a property that you control, you own, or you have passive investors who have a manager who's making that decision. You know, passive investors or LPs, limited partners, who are not driving the decision.
Yeah.
So it's a you know, great opportunity that to have defer your taxes. You just got to make sure you're doing it right.
Yeah, and more than anything, Jameson, I love that it feels like every week now that you and I have these conversations on Kiss My Assets, that we're having more and more conversations about liquidity and more liquidity in the market. And I want to kind of switch topics to this one of these new articles that we took a deep dive into about how commercial real estate capital raising has been on pace to surpass pre-pandemic levels, which is quite incredible from a capital raising perspective. But you know, that 1031 article, some of the other things we've discussed on the previous podcast, there just seems like more transaction volumes happening, more liquidity is happening. And so for those listening, that's exciting. That's a green flag for you to maybe get off the sidelines and start looking at deals, start looking at opportunities here as things start to shift. So this article we took a deep dive into talks about how a fresh wave of capital is starting to come to the United States. Lots of different examples. For example, Blackstone's REIT, they just raised $1.1 billion this last quarter. That's the most they've raised in 2.5 years.
Yep.
Right. There's other funds that have closed some of their largest funds. For example, Brookfield Strategic Real Estate Partners raised Fund 5 at $16 billion. Carlisle Realty Group closed at $9 billion.
Those are some big numbers.
Yeah, big numbers, big numbers. Love to get to that. But, you know, it seems like investor sentiment is starting to change after a couple challenging years.
Yeah, I mean, this is kind of another uptick from what we've seen after the past few years. These are big funds who have some of the smartest folks. Some of their investors are the smartest folks. They're looking at the right data. And, you know, the old saying, let the trend be your friend. Yeah. And we're starting to see some of these cash inflows come back into real estate, still in the early innings of the recovery. But there were three things that I wanted to point out as to why commercial real estate is starting to recover. The first one is around office, and office availability has been gradually declining across the country. So we saw some pretty staggering occupancy rates in these big office towers. Those occupancy rates are heading in the right direction.
Yeah,
some of that has to do with those properties being converted to other uses. It has to do with some lease-ups, people returning back to the office.
Yep.
But that number's heading in the right direction. The second one, industrial, is benefiting from a slowdown in speculative construction. So industrial saw a big boom of new supply. Over the last 3-4 years, it was kind of the new hot investment on the street. A lot of stuff was built, overbuilt. That slowed down. So industrial's starting to stabilize. Still a lot of vacancy in industrial because they kind of overbuilt. But most of those places were built in the right areas, and they'll get absorbed. But that's heading in the right direction. And then finally, the third one, which is where we sit, multifamily.
Yeah.
Multifamily vacancy rates are ticking lower. So we also saw a lot of multifamily construction of new units. These new units are being absorbed, and we're starting to see occupancy rates go down. So these three things all heading in the right direction, and they're all kind of doing it at the same time.
Yeah, and in conjunction, we're seeing an uptick in loan originations, right? From a macro perspective, loan originations are up more than 30% year over year in the first half of 2025. So you have some debt liquidity there with some of these rebounds that you were talking about from an absorption standpoint, but also property sales, which is pretty amazing.
And for an operator, lending has been tight. Seems like it's starting to loosen up a little bit. Money is starting to move a little bit more, and loan originations are picking up. Private capital fundraising is on pace to hit about $130 billion this year. That would be the highest since 2019, excluding 21 and 22, which were really outliers.
Yeah.
So if we get back to that 2019 number here in this year, it does indicate that things are starting to turn back around. Yeah,
absolutely. And from your perspective, I know, Jameson, you actively follow, of course, what the Federal Reserve is doing. The Federal Reserve and those guys in there are actively studying these statistics as well as us, right? We've experienced a 25 basis points cut back, this past month in September. Where do you see things going from a Federal Reserve standpoint, seeing these kinds of indicators?
Yeah, most people kind of on the Wall Street consensus think we are starting a cycle of rate declines. We saw the quarter point earlier this month. We also are starting to see employment numbers soften. We also know that we're going to get a new Fed chair in the first half of next year, who is going to be a what we call a dove Fed chair. They're going to want to keep rates low. They're going to be appointed by Trump. There's a lot of indications that we're going into a cycle over the next period of years where rates are going to be declining, and that benefits many industries that raised debt, real estate being one of the top. That's why you start to see more inflows in some of these big REITs. That's why you start to see the stock market has done really well, especially stocks that are tied to heavy debt, and they benefit when interest rates come down. So it does remain to be seen, but from our standpoint, I think it's very likely we are in an environment now where rates start to decline in a cycle. Now, one 25 basis point decline doesn't do that much for you, but what does is if it's a cycle and it appears over the next period of years we're going to go into that cycle. I really like that from an investment standpoint, because if you can buy stuff today at current interest rates and they're cash flowing and they make sense today, and interest rates go down over the next period of years, your fixed income, your fixed cost of interest, you can go refinance that and now see some significant increases in your cash flow, because your debt amount can stay the same, but the amount of interest you're paying is less. So make stuff, when you're doing projects today, make sense under today's conditions, and now you just have additional upside down the road when you go refinance.
Yeah, absolutely. And speaking of which deals a lot of what we're talking about is institutional investors are targeting. They continue to favor multifamily and industrial properties right now, kind of mirroring patterns that we saw over the pandemic. A stat here is out of the 20 largest non-secondary real estate equity funds closed this year, 13 list multifamily, industrial, or both as focus areas.
Yeah. Multifamily is still undersupplied in many markets, especially as you look at the slowdown in new multifamily starts. That's come to a screeching halt. Home builders are not building near the levels that they need to. These macroeconomic trends continue to be kind of gives a thumbs up to where multifamily is going and where and how needed it's going to be, the stability around owning housing.
Yeah, and there's a couple real estate niches that we haven't touched on, but Jameson, with this consistent theme of a resurgence in debt and equity deployment, what's your message to our audience, to our listeners who are out there who are seeing all these indicators or maybe learning about these indicators today? What's your message to them?
Well, everybody needs to take a look at where their situation is today and make their own decision based on what some of this that we're seeing. And what we're trying to point out is how we're interpreting some of this data. And we could definitely be wrong in how we're interpreting it. In fact, most of the time, if you can be right 60, 70% of the time, you're doing really well. From our standpoint, if we can buy properties in good locations today, I think it's a great time to buy great assets today. You need to be able to cash flow them. You need to be able to put permanent debt on them. I'm not a fan of bridge debt. We've seen so many in today's environment. In projects where you can get permanent debt, it's much better. Now, if you're doing a big renovation project, bridge debt can make sense. But when you're underwriting, just take a look at, if we have permanent debt in place, say, what can that be? What does that look like? Because in a rate environment that we're going into, and you can refinance this project a few years down the road at a lower rate, then that just adds cash flow. So keep it simple. We're buying. We're a little earlier. There's not as many. A lot of groups right now are still on the sidelines, and I think that's an opportunity, and that's the opportunity we're taking.